If you're tired of financial confusion and misinformation, you've come to the right place. In this video, we'll be dissecting the most prevalent financial misconceptions to help you make informed decisions about your money. Before we move on, make sure to hit that subscribe button. So, let's dive in. The myth of quick riches is a prevalent belief that tantalizes many with the promise of achieving significant wealth swiftly, all without the need for sustained effort, careful financial planning, or disciplined saving. It often manifests through various alluring schemes, including get-rich-quick programs, speculative investments, and the allure of sudden windfalls like lottery winnings or unexpected inheritances. This myth can be particularly seductive, as it taps into our desire for instant gratification and the dream of escaping financial struggles effortlessly. However, the reality is that such shortcuts to wealth rarely pan out as envisioned. They tend to lead to financial disappointment, losses, and sometimes even distress. It's crucial to approach the idea of quick riches with skepticism, focusing instead on tried-and-true methods of wealth building that prioritize sustainability and long-term growth. Debunking the good debt versus bad debt myth involves challenging the simplistic categorization of debt into good and bad categories. This commonly held belief suggests that some debts, like mortgages or student loans, are considered good because they can potentially yield long-term benefits, such as home equity or education, while others, like credit card debt, are seen as bad due to their high interest rates and potential to erode financial stability. However, this classification can be misleading. The truth is that all debt carries risks, and whether it's beneficial or detrimental depends on factors like interest rates, how it's managed, and its impact on your overall financial well-being. The true nature of a debt often lies in the terms of the loan, the individual's financial situation, and the purpose and value of the purchase. The truth about credit cards and financial health is, when used responsibly, credit cards can be a tool for building a strong credit history and accessing financial benefits, such as rewards and purchase protections. However, they can also be a double-edged sword. The convenience of swiping a card, combined with the allure of instant gratification, can lead to overspending and mounting debts with high interest rates. It's this potential for accruing debt and the consequences of not managing repayments that can harm one's financial health and credit score. Ultimately, the impact of credit cards on an individual's financial well-being depends on how they are used. With disciplined spending, timely payments, and a clear understanding of interest rates and fees, credit cards can be beneficial. But without caution, they can quickly become a financial burden. Investment myths surrounding risk, returns, and diversification often lead to misconceptions about effective investment strategies. Many believe that high-risk investments inherently yield high returns, but the reality is far more nuanced. While greater risk can potentially lead to higher rewards, it also carries the potential for significant losses. Additionally, the idea that diversifying a portfolio entirely eliminates risk is another myth. Diversification can reduce risk, but it doesn't eliminate it entirely. A well-balanced investment approach involves a careful consideration of one's risk tolerance, investment goals, and a diversified portfolio that spreads risk across different asset classes. Homeownership is a phenomenon that deserves careful consideration. While owning a home is often viewed as a symbol of financial stability and an investment in one's future, it's essential to recognize that it may not be the right choice for everyone in every circumstance. The decision to buy a home should align with your long-term financial goals, lifestyle, and the local housing market. Factors such as the duration of your stay in the area, the state of your personal finances, and your willingness to take on the responsibilities of homeownership all play a crucial role. Owning a home entails not only mortgage payments but also property taxes, insurance, maintenance costs, and the potential for market fluctuations. In some cases, renting may provide more flexibility and financial advantages. Therefore, determining whether homeownership is a smart move requires a thoughtful analysis of your individual circumstances and objectives, taking into account both the potential benefits and challenges associated with this significant financial commitment. When it comes to retirement savings, there are critical misconceptions surrounding retirement planning. One common myth is the belief that you should start saving for retirement later in life when you have more income or fewer expenses. However, the truth is that the earlier you begin, the more time your investments have to grow, harnessing the power of compounding. Waiting can significantly limit the potential for building a substantial retirement nest egg. Another myth relates to how much you should save. While conventional wisdom often suggests saving a fixed percentage of your income, the reality is that the ideal savings rate varies for each person and depends on factors like income, age, and retirement goals. It's essential to assess your unique circumstances and create a tailored retirement savings plan. Ultimately, the key takeaway is that starting early and regularly adjusting your savings strategy to align with your evolving financial situation are fundamental principles in building a secure retirement fund. Lifestyle inflation is a common societal pressure to match the spending habits and lifestyle choices of peers or neighbors. Many people feel the need to constantly upgrade their possessions or experiences in response to the perceived affluence of others. This behavior, known as lifestyle inflation, can lead to financial stress and hinder long-term financial goals. The reality is that true financial success isn't about outspending others. It's about making wise financial decisions that align with your personal goals and priorities. Falling into the trap of lifestyle inflation can erode your ability to save, invest, and build wealth for the future. Instead, focus on financial goals that genuinely matter to you, and resist the urge to overspend simply to keep pace with others. By debunking the fallacy of lifestyle inflation, you can lead a more financially secure and fulfilling life tailored to your values and aspirations. Let's explore misleading ideas surrounding the relationship between taxation and wealth accumulation. One widespread misconception is that paying taxes significantly diminishes the potential to build wealth. While taxes do impact your income and assets, it's crucial to understand that taxation is a fundamental part of a functioning society, funding public services and infrastructure that often contribute to economic growth. Another misconception is that the wealthy have an unfair advantage in avoiding taxes. While it's true that tax planning strategies can be complex and offer certain advantages, everyone can benefit from understanding tax laws and optimizing their financial decisions within legal bounds. Finally, the idea that reducing tax liability is the sole path to wealth is a misperception. Effective wealth building involves various factors, including income, savings, investments, and financial planning, in addition to tax considerations. By addressing these misconceptions, individuals can develop a more informed perspective on taxes and their role in achieving financial goals. We've explored a range of critical topics that dispel common myths and offer insights into the world of finance and wealth management. From retirement planning to debunking misconceptions about taxes and wealth, our aim is to equip you with the knowledge you need to make informed financial decisions and achieve your goals. If you've found this information valuable, don't forget to subscribe to our channel. There's no better time than now to subscribe.